Hi, welcome to today's video, and today we're going to discuss purchasing a property through a special purpose vehicle, otherwise known as a limited company. Buying a property for a special purpose vehicle is one option to consider when purchasing an investment property, i.e. a buy-to-let property. The main reason for doing so is to make your property purchase or eventual property portfolio more tax efficient versus owning the property in your personal name. There are many reasons why this could be a good idea, but also just as many where it may not be a good idea, and it's always important before considering anything you discuss your circumstance with a qualified accountant who is experienced with buying properties through a company structure. So let's look at some of the advantages and considerations with purchasing a property through a company structure. Special purpose vehicle versus limited company. First things first, what is a special purpose vehicle? A special purpose vehicle, or SPV for short, is a specific type of limited company you can set up in the UK that's sole purpose is to buy, own and rent out and sell property. Though it is often referred interchangeably to a limited company, there are some significant differences. An SPV for HMRC and the mortgage provider's point of view is a company structure for properties to sit within, whereas a limited company could be in practice a trading business. Let's look at an example. An example is Sweets Limited is owned by Tim for his sweet shop. Though in theory his sweet shop limited company could buy property, it would be for many reasons unwise or impractical, namely due to the fact if something went wrong with his business, that could put his property at risk, and vice versa, if something went wrong at his property, that could put his business at risk, as in both cases the property would be seen as an asset of the business. Mortgage lenders normally don't like this essentially for the same reasons. As in the above example, for a mortgage lender doesn't want to be faced with losing a property they'd mortgage against because of other activity related to a trading business. For this reason, in most cases, a property would be bought through an SPV or a special purpose vehicle. Why would you consider an SPV versus personal ownership? There are many reasons to consider, but the main reasons are below. Tax relief on mortgage interest. So mortgage interest is no longer an allowable expense for buy-to-let landlords, as you can't deduct it from your rental income. Instead, you receive a 20% tax credit based on your mortgage interest payments. However, this doesn't apply to landlords who hold properties in an SPV, which means limited company landlords may be able to significantly reduce their tax bill. Mortgage interest relief is typically the number one reason to normally consider an SPV purchase, to normally be able to offset your mortgage interest only payments and make your property and portfolio more tax efficient. One of the further main advantages of an SPV setup is being able to separate the rental income from your personal income. When a property is owned in your personal name, the rental income is added to your personal income for that tax year. This can quite often therefore push you into the higher rate tax bracket, further increasing your tax bill. But with the property within the SPV, the rental income firstly comes into the business bank account. All costs and taxes incurred for the buy-to-let property business is deducted, and then after corporation tax you find yourself left with the net profit, with this then payable to you via taking a dividend typically. So with the rental income separated from your personal income, you're not automatically pushed into the next higher rate tax band as an example. Furthermore, depending on your circumstance, you may not wish to be paid any further in the current tax year due to potentially pushing you further into the higher rate tax bands, and so can simply leave the profit within the SPV and take it at a future date of your choosing. This helps you retain full control over how much and when you pay yourself from your buy-to-let. You may wish to then take the profits in the future, perhaps when your income is lower or you've retired. Equally, if the property is owned in joint names via an SPV and one of you is a non-earner or well within the basic rate tax band, you may choose to distribute profits more to that party. This is certainly an area to discuss with your accountant, so you receive the most relevant tax advice specific to your own individual circumstance. Increased mortgage borrowing. Allowing for the lower tax bills on your buy-to-let when you're a higher rate or additional rate taxpayer, mortgage lenders will typically lend you more on an SPV buy-to-let, as they will know you have more cash flow to allow for your bills and not subject to significant tax bills. Ease of transferring ownership. As an individual investor, you would usually be subject to capital gains tax if you wanted to gift the property to a family member. For a basic rate taxpayer, this is charged at 18% and 28% if you're a higher rate or additional taxpayer. If the property is held with an SPV, however, the beneficiary can easily be added as a shareholder to inherit the property at a later date. This can also help reduce your tax estate for inheritance tax purposes. This is certainly an area again to discuss with your accountant so you receive the most relevant tax advice to your own individual circumstance. Stamp duty land tax should always be confirmed with the solicitors or your accountants before beginning any property purchase, as this can be a complex area of taxation and many factors can influence your eventual tax bill, such as if you are married to someone who already owns a property or if you already own property outside of the UK. Higher rate taxpayer SPV example. Let's look at an example of the income tax implications of a property being bought in your personal name and one being bought in an SPV. Just an important disclaimer before we get started, the below numbers are examples and should never be relied upon before making a decision to proceed with an SPV purchase. You should seek independent tax and legal advice to ensure you have received up-to-date professional advice and guidance on purchasing a property through an SPV company. Let's look at an example of a property worth $400,000 with a mortgage outstanding of $300,000. There is £1,750 per calendar month rental income, equating to £21,000 per year. Let's say as an example, this £300,000 mortgage has an equivalent rate of 4.99 being paid, so the mortgage annual interest payments accumulate to £14,970. Let's say the annual property costs are roughly £2,000 as an example, so this could be things like letting agents fees, which are deducted, repairs, maintenance, service charge, buildings insurance, landlord's insurance, business protection, etc. Your costs obviously may be more or less than this, but let's just use $2,000 as an example. With the property in your personal name, let's look at the numbers. Personal ownership. Property turnover at $21,000 minus your $2,000 costs means there is $19,000 left over. The $19,000 is therefore your gross profit, which would be taxed at 40%, resulting in a tax bill of £7,600. You then receive a basic rate tax credit on the interest mortgage, which is 20%, which then means that would be a credit of £2,994. You then deduct the £2,994 basic rate tax credit from the higher rate tax of £7,600, resulting in a tax bill due of £4,606. So putting all those numbers together, £21,000 rental income received, deducted of £2,000 of costs, deducting of £14,970 worth of mortgage payments, deducting £4,606 as a tax bill, means the property in that year, in this example, was loss-making by £576. This would be a loss that in practice you would need to find from your own pocket. Let's look at an SPV ownership example. Property turnover, rental income, £21,000, minus your £2,000 costs, minus your £14,970 mortgage interest, leaves you £4,030 in theory as a gross profit. Corporation tax is then applied to that of 25% typically, resulting in a 1008 tax bill. So you would then take your £4,030 gross profit minus your corporation tax bill of £1,008 to give you a £3,022 profit. The £3,022 available profit could then be taken as dividend or potential director's loan reimbursements. These can be taken at your discretion as a director, and you only incur personal taxes on these amounts when you withdraw them from the SPV. In the above example, it appears the property has significant positive cash flow now that it is within the limited company. Corporation tax is currently 25% as of this current tax year. Always obtain advice from your accountant as it is subject to change. Typical steps to buying a property through an SPV. Number 1, speak to your mortgage broker to understand the typical mortgage options and how they differ depending on which ownership option you consider. Number 2, speak to an accountant to receive tailored bespoke advice specific to your individual circumstance. Number 3, confirm whether the deposit is coming from either a gift or from equity within the property itself already, or from existing savings. Number 4, mortgage certificate issued so you know your budget and the property you can purchase up to, and therefore you're good to proceed to make an offer on a property. Number 5, incorporate company at company's house, ensuring the correct company reference numbers, SIC codes are used. These can vary depending on the lender you're likely to proceed with, so your mortgage broker will be able to advise you of these in advance. And number 6, start your property search and engage with a solicitor who deals with SPV property purchase transactions. Frequently asked questions for SPV buy-to-lets. How to set up an SPV. Appoint at least one director or one shareholder. Prepare your company name, address and details of the directors. The Memorandum of Associations and Article of Association should define the company as an SPV, define the company SIC code, and submit all information to Companies House. Ideally, your accountant should do this for you to ensure it all processed correctly. I already own a property, can I transfer this into an SPV? Yes, albeit you don't transfer the property into an SPV technically. The SPV buys it off you and is treated as a purchase transaction. Do I need to save a deposit if I already own a property being purchased by an SPV? No, you're able to transfer your existing equity in the property as you're purchasing the property. Again, the transaction is treated as a purchase event, hence why stamp duty is payable. How much stamp duty land tax when I purchase a property through an SPV? Your solicitor at the time of purchase will confirm your stamp duty land tax bill, but if it's a standard residential property, it will usually be the normal 3% additional rate payable. Again, your solicitor will confirm the exact stamp duty due at time of purchase. Do I have to use an accountant and a specialist type of solicitor for an SPV, purchase and mortgage? We highly recommend you do, as this is a very specialist area of tax planning and specific legal considerations need to be comprehensively covered, so it's very important you get independent tax and legal advice. Please remember the brief examples we've covered in this video is meant for illustrative purposes and is to give you an idea of how an SPV limited company purchase compares to personal ownership. It is not tax advice and it should not be relied upon for making any decisions. You must seek professional tax planning advice from a qualified tax advisor, which we can introduce you to, who can discuss your circumstance in more detail, and equally from a legal point of view, you should engage with a solicitor who is able to give you advice independently relating to the legal considerations of buying a property within a limited company structure. Thanks for watching this brief video. We hope you found it very useful. Please like and comment below if you have any thoughts, and equally subscribe to our channel so you don't miss out on our next video.